So chapter 14, the reason I want to do this on its own is there's some challenges with this. It's not terrible, but there's a unique aspect with liabilities as it pertains to loans. So I'd like to just focus on this chapter solely. And that's why today we can't get out really any earlier because I want to make sure I cover everything. We're going to do problems 1, 2, 3, and 4 for homework. We're not going to worry about problem 5. Okay, just 1, 2, 3, and 4. Okay. So we're going to take a certain aspect of the chapter, work on some exercises, go back and build on it, just like we've done in the past, okay? I want you to know, at least for me, this was a little bit of a challenging chapter. And maybe I'm crazy, but we're going to go over it. When it loads, okay, there we go. So this chapter focuses on how we record and account for long-term liabilities. Liabilities, we know, are the sacrifices, the future sacrifices, or the monies that a company owes, needs to pay back. So, recognition. Now, every chapter we talk about these various concepts. Recognition is when we record a transaction. Valuation is how much we record, assigning a monetary value. And classification is where we record it, the proper account. And then disclosure is, do we need to add any additional notes to the financial statements related to debt? What are long-term liabilities? They're debts and obligations that a company expects to satisfy in greater than 1 year or beyond its normal operating cycle. Remember, short-term liabilities will be due within the year. We're going to pay them or satisfy them within the year. Long-term, that debt is not going to be paid off within the year. It's going to be 1 year and greater. Generally accepted accounting principles require us that liabilities are recognized and recorded when an obligation occurs, even though the obligation might not be due for many years. So, in the scenario of a home, my husband and I purchased a home, and we have a 30-year mortgage. Now, we have to pay so much each month over 30 years. We have to record, if we're doing a financial statement, we show what we purchased the home for, but correspondingly, we have to show what we owe on this home, even though some of it might not be paid off 20 years down the road. We still have to show the whole amount because we owe it, right? Even though we're not going to pay it off for a long time, we still owe it. Long-term liabilities are valued at the amount of money needed to pay the debt or at the fair market value of the goods or services that are going to be delivered. If we're not using cash, we're using services or goods, we would record it at the fair value. A liability is classified as long-term when it's due beyond 1 year or the normal operating cycle. Because of the complex nature of many long-term liabilities, oftentimes you've got to have a lot of disclosures in the financial statements. Types of long-term debt we're going to talk about. One of the biggest ones relates to bonds. Bonds payable, the most common type of long-term debt. It's more of a complicated instrument than just owing a note. So we'll talk about why. Usually with a bond, companies may issue bonds and various investors purchase those bonds. So we're not just dealing with one particular person we owe money to. We generally have it lumped a group of people. A note payable is a little different. That's a promissory note where we have a signed document and we owe either a creditor or a bank a certain amount of money at a certain interest rate. Mortgages are debts secured by property or land, and usually mortgages, you pay that a fixed amount each month for so many installments, usually 360 installments. Here, this shows an example of when we take out a $100,000 mortgage and we pay a fixed amount each month on this mortgage. Now it shows this is a 9% mortgage. So you see here, we took the mortgage out on June 1st. On July 1st, we made a payment of $1,200. The way we assign this payment is the amount that goes to interest, then the difference will go to pay down the principal. So on July 1st, if we have a $100,000 mortgage times 9% divided by 12 months, or in this case, they said 0.75%, because if you take 9%, that's over an annual 12 months. Do you know what I'm saying? 9% on 100,000 is $9,000. But if you divide that by 12 months, it's $750 a month. See what I'm saying? So that $1,200 payment, the first $750 goes to interest. The difference, the $450 goes to principal. So the $100,000 loan minus $450, because we paid down the principal of $450. At the end, or as of July 1st, instead of owing $100, now we owe $99,550. So for the next month, we're going to pay interest on $99,550 at a 9% interest rate divided by 12, or 0.75%. That's $747. So if we make a $1,200 payment and the interest portion is $747, the difference between $1,200 and the $747, or the $453, is what we're paying down our principal again. And now our balance is the $99,550 minus the principal of $453, and our loan went down to $99,097. Then the next month, we pay interest on the $99,097. Our payment is fixed at $1,200. Again, the way we calculate the interest is $99,097 times 0.75%, or $743. Our payment of $1,200 minus the amount we paid in interest. The difference is what we're paying down in our principal, isn't it? Does that make sense, guys? So, the mortgage was obtained in June. The monthly payments are fixed at $1,200. So what happens is the way we calculate the interest, $100,000 at 9% times 112, is $750. The difference, the $450, $1,200 minus the $750 or the $450 pays down our principal. So as you see here, the cash is $1,200. $450 of it pays down our mortgage, but the mortgage interest expense is $750. So this is how we'll show the journal entry as it relates to paying a mortgage payment. Okay? So that scenario here is how we would handle a mortgage. Let's go and look at a problem real quick, okay? E1A on page 589. E1A, Pittman Corporation purchased a building by signing a $75,000 long-term mortgage with a monthly payment of $1,000. The mortgage carries an interest rate of 12%. So 12% a year is 1% a month, isn't it? Prepare a monthly payment schedule showing the monthly payment, the interest for the month, the reduction in debt, and the unpaid balance for the first 3 months. So we're going to start at $100,000. So, excuse me, $75,000. So do you see here? We start at $75,000. Okay? Now, if our payment is $1,000 a month, excuse me. If our payment is $1,000 a month, the way we calculate our interest is 75,000 times 1%, or 750. Okay? The 1,000 minus the 750, or the 250, is going to pay down our debt. So after the end of the first month, our 75,000 minus our 250 gives us 74,750. So when we go into the next month, we take our 74,750 times 1%, or $748. We'll take our $1,000 minus our $748. Now we're going to reduce our debt by $252 because our $1,000 is our payment. We first have to subtract what we paid in interest, and the difference is what we're paying in our principal. So at the end of the second month, our loan balance is $74,498. Now I want you to go and see how are you going to do the third month. Okay? $745 is the interest. How many agree? The 1,000 minus the interest to $745. The difference, $255, reduces our debt. So at the end of the third month, our loan balance is $74,243. Perfect. Now, it says, prepare the journal entries to record the purchase and the first 2 monthly payments. So if we purchased a building by signing a $75,000 long-term mortgage with monthly payments of $1,000, basically the first payment or the first journal entry is going to be a debit to building for $75,000, a credit to mortgage payable for $75,000. And our explanation will be purchased a building by signing a mortgage. At the end of month 1, we're going to show, based on our calculation up here, mortgage interest expense of $750. Mortgage payable is a debit of $250 because a payable has a normal credit balance. But when we pay it down, don't we debit it? Right? To reduce it. And we credit our cash of $1,000. Next, we're going to take that information from month 2. We're going to do the same thing. Mortgage interest expense is $748. The mortgage payable is $252. And our cash is $1,000. Does that make sense? Okay. Now, as we move on, long-term leases. A long-term lease is, instead of actually purchasing an asset, we lease it for an extended period of time. When a lease has a term that closely corresponds to the life of the asset, and it's kind of more like a purchase because we're going to use it for up to most of its life, then it's called a capital lease. So let's say instead of going out and actually purchasing a building, we're going to lease that building for 25 years. Okay? Now it's a lease, but generally accepted accounting principles requires that we record this long-term lease in a different fashion than what we would do with a short-term lease. Another type of liability are pensions. A lot of companies pay into the pensions of employees. Pension liabilities arise from contracts that require a company to make payments to its employees if they've retired. There are other post-retirement benefits that become long-term liabilities. And there's something called deferred income taxes, where we know we're going to be paying income taxes on revenues, but we're not going to pay them until down the road, but we have to show that liability as we know it's occurred. So I'm going to let you do this, apply it, where you match what the liability is along to the debt. So bonds payable, long-term notes payable, a mortgage payable, long-term lease, pension liabilities, other post-retirement benefits, and deferred income taxes. The cost of health care after employees' retirement, what would that be? Anybody? F, other post-retirement benefits. The most common type of long-term debt? A, bonds payable. The result of difference between the accounting income and taxable income will be deferred income taxes. Debt that is secured by real estate? Mortgage. Promissory note that is due in more than a year? Long-term notes payable. Company requirement to make payments to its employees after they retire? Pension. Often similar in form to purchasing a long-term asset? Long-term lease. Awesome. Now, this section is what we're really going to focus most of our time on. How we record bonds. Okay? Bonds, record bonds issued at face value, at a discount, and at a premium. So we're going to understand specifically how bonds work and how we need to record them. A bond is a security, long-term, representing money that a corporation borrows from the investing public. There are two ways that companies receive money. One is they have stockholders, and investors purchase stock with the company, and they own a share of the company. That's equity. Another is a bond. It's a liability, where investors lend the company money in the form of a bond, and the company is required over a period of time to pay those investors back. So one is in the form of stock, the other is in the form of borrowing money, debt, long-term, and they have to pay the investors back. A bond shows a promise to repay the amount borrowed, called the principal, on a specific date, and to pay interest at a specific rate at a specific time. Usually it happens semi-annual, sometimes annually. When a public corporation issues bonds, it must receive approval from the Securities and Exchange Commission to borrow funds. The Securities and Exchange Commission reviews the corporation's financial health and the specific terms of the bond indenture, the bond agreement, which is a contract that defines the rights, the privileges, and the limitations of the bondholders, including things such as the maturity date, the interest payment dates, and the interest rate. As evidence of debt to the bondholders, the corporation gives those investors something called a bond certificate. Instead of a stock certificate, which you get when you own stock, when you lend the company money, you will have a bond certificate, similar to like a note that shows you've lent the company this amount of money and they have to pay you back at a certain date with certain interest payments and at a certain interest rate. A bond issue is the total value of bonds that are issued out at one time. The prices of bonds are stated in terms of a percentage of the face value or principal of the bonds. So a bond issue quoted at 103.5 means that a $1,000 bond costs $1,035 and sells at a premium. So there's a $1,035 bond, $1,000 bond. And sometimes, depending on what that face value of the interest rate shows on the bond, bonds may be issued at what's called a premium. If it says the bond is issued at 103.5, that just means 1,000 times 1.035 or $1,035 is what the bond is issued for. When a bond sells exactly at the face amount at 100, it is said to sell at face value or par value. Then we've got bonds being issued at a discount. A bond quoted, a $1,000 bond quoted at 87.62 would be selling at a discount and would cost the buyer $876.20. So if there is a bond that is being issued at a premium, what that means is that investor needs to give $1,035 to the company. And then the company will pay them back over time. Excuse me, I'm saying that opposite. When the bond is sold at a premium, then the $1,000 bond, yeah, exactly. The person who's investing in the bond gives the company $1,035 and eventually will get $1,000. We'll talk about this because it gets confusing. The bond that's sold at a discount means that the buyer gives the company $876.20 to one day down the road get $1,000 back. How's this work? The reason there's a discount or a premium is due to the interest rate on the face of the bond. The face interest rate is the fixed rate of interest paid to the bondholders based on the face value of the bond. So basically the face value is just what's stamped on that bond, the interest rate. But the face value doesn't always coincide with the market rates, okay? Right now, the market interest rate is like 1 or 2%, okay? The face value on the bond might show 8%. The reason you issue them at a premium or a discount is to get the face value in line with what's really going on in the market. Does that make sense? The market interest rate fluctuates daily. This fluctuation causes bonds to sell at either discounts or premiums. A discount equals the excess of the face value over the issue price. The issue price will be less than the face value when the market interest rate is higher than the face interest rate. So let's say on the face of the bond, it has an interest rate of 3%. But the current going market rate is 6%. Why are you going to invest in a bond that's showing 3% when the market's going for 6%? So the way a company handles that is you will only give them a lesser amount because technically you're getting a greater rate of interest. Instead of you giving them 1,000 and then they give you back 1,000, you're going to give them a lesser amount. And you're going to get your 3% interest, but you're going to end up getting $1,000, which is going to increase ultimately your interest because of buying it at a discount. Hang in there, guys. Premiums equal the excess of the issue price over the face value. The issue price will be more than the face value when the market interest rate is lower than the face interest rate. So that example I just told you, the face of the bond says it's going for 7%. But if the market is only at 2%, you're going to have to buy that bond for probably $1,050 versus just $1,000 because the going rate's 2%, not 7%. Okay? Hang in there. There's different kinds of bonds. One's called unsecured bonds, one's secured bonds, and then there are some bonds out there that are called term bonds. So unsecured bonds basically is general debt. Secured bonds basically are linked to specific assets. So if the bonds don't get paid back, you've got security in assets. Term bonds are when all bonds of an issue mature at the same time, and serial bonds mature on different dates. So there are all kinds of different instruments out there. Callable bonds are when the company can buy them back from you before the maturity date. When companies retire bonds before its maturity, it's called they are doing an early extinguishment of debt. Why would they do that? Well, think there may be bonds that were issued 20 years ago at an 8% interest rate. But today they can go and borrow money for 3%. Do you see how they would want to go ahead and call those bonds in so they're not so expensive, and then issue some new bonds at a lower interest rate? Because it costs more money to pay 7% on their money than 2 or 3%. Convertible bonds allow a bondholder to exchange a bond for a specific number of shares of common stock. So an investor gives the company money with the plan to get paid back. But the investor has an option to buy stock in lieu of getting paid back. Registered bonds are issued in the names of the bondholders. And coupon bonds aren't registered. They have these coupons the bondholder removes on the interest payment dates and goes to the bank and gets paid. So let's do some examples of how this works. Carrot Corporation issues $200,000 of 7% 5-year bonds on January 1st and sells them on the same date for their face value. The bond indenture states that interest is to be paid January 1st and July 1st of each year. So basically we're hearing that 7% face value interest rate is what the market's saying. So you would issue at par or face value because the interest rate in the market is the same as the interest rate on the bonds. Make sense? So to record issuing bonds, we would show an increase in our cash and a corresponding increase in bonds payable. The amount's the same. Cash gets increased $200,000 and bonds payable gets increased $200,000. We sold $200,000 of 7% 5-year bonds. Now we need to record the interest for every 6 months. So Carrot pays the interest on January 1st and July 1st of each year. So on July 1st, we need to show how much interest do we owe. Well, if it's 7% interest rate on $200,000, 7% times half a year times $200,000 gives us $7,000. Okay? So the way in which we're going to record paying interest to the bondholders is going to be bond interest expense as a debit of $7,000, and we'll credit our cash of the exact same amount. Okay? Now, it's going to get a little trickier. Carrot issues $200,000 of 7% 5-year bonds at 95.9445 on January 1st. So they're issuing them at a discount, aren't they? When the market interest rate is 8%. So the face value of the bonds shows 7, but the going market's at 8. In this case, the bonds are being issued at a discount because the market interest rate exceeds the face interest rate. So how are we going to record this transaction? We only received 95.9445% of the face amount. So as you see here, the 7% bonds, 200,000, but we have something called an unamortized bond discount of 8111, which really makes the bonds on our books show at 191,889. So this account, this unamortized bonds, is like a contra account, a contra liability. Its balance on this less unamortized bonds gets deducted from the face amount to arrive at what we call the carrying value on the loan, the bonds. The bond discount is described as unamortized because it gets amortized or written off over the life of the bonds. You can't yard. It's so contagious. So let's look at this. We sold $200,000 of 7% 5-year bonds at 95.9445. So if we take 200,000 times 95.9445%, we're going to get 191,889. That's what we received in cash. Okay? That's what we got in cash. So the difference between the face amount on the bonds and what we received in cash is that unamortized bond discount. Now, another scenario is bonds get issued at a premium. Carrot issues 200,000 of 7% 5-year bonds for $208,530 when the market interest rate is just 6%. This means investors purchase the bonds at 104.265% of the face value. In this case, the bonds are being issued at a premium. So what happens here is instead of just getting $200,000 in cash, we're going to get $208,530 in cash. So what happens here is we are going to show cash of $208,530. We're going to have an unamortized bond premium of $85.30, but our bonds payable are going to show the face amount of $200,000. The bonds payable will always be that face amount. So let's look at a problem. Okay? E3A. Sang Inc. is considering the sale of 2 bond issues. Choice A is a $1,600,000 bond issue that pays semi-annual interest of $128,000 and is due in 20 years. Choice B is a $1,600,000 bond issue that pays semi-annual interest of $120,000 and is due in 15 years. Assume that the market interest rate for each bond is 12%. Calculate the amount that Sang will receive if both bond issues are made. So, what we've got to figure out is the present value. So if we go here to E3A, what we're going to do is, in this first example, the $128,000 times, if we look at 5 years, or was it 5.5 years? Is due in 20 years, I'm sorry, 20 years. So in this scenario, choice A, we're going to pay $128,000 every 6 months, and it's due in 20 years. So what we're going to do here is we're going to go to the table in the back of the book, and we're going to look at 20 years times 2 payments a year, right, are 40 payments at 6%. So if we go to table 2, then what we'll see is that payment of $128,000 times we go to the 40 period payments at 6%, and we'll see the amount we need to use for the present value of that at 15.046. So basically, we are going to need to pay, in today's money, $1,925,888. That's the present value of $128,000 times 40 payments. Does that make sense? So 128 times 40 is what, guys? 128,000 times 40 is going to be a lot more than 19.25%, isn't it? Why don't you look? What is it? 5,120,000. But today's value of that 5 million over 20 years is 1,925,888. Now, the next one says, if you look here, instead of paying it every 6 months, choice B is a $1,600,000 bond issue that pays semi-annual interest of $120,000 and is due in 15 years. Okay, so it is still paying it is paying semi-annually, but it's paying $120,000. Okay? And we're going to see that semi-annual interest of $128,000. This one is paying a 12% rate also, but it's due in a shorter amount of time. So down here, if we go to the present value of 15 semi-annual payments at 6%, the reason we're taking 6% is we pay 6% every 6 months. We go to the chart, 120,000 times, if you hone in on that figure, 13.765. The present value of $120,000 times 30 payments is $1,651,800. So the way we calculate that present value is we go to that table to determine what is today's value of all those payments carried out. Okay? Got that? So that's the first step we do. Now, the next step is we have to make these payments every 6 months. But in choice A, we owe $1,600,000 in 20 years. So we've got to come up with $1,600,000 in one lump sum in 20 years. Does that make sense? We have to pay that interest each month, but the $1,600,000 due in 20 years, what is that really the present value of that money today? So what we would do, Table 2 is an annuity. You know, we pay it every so often. But the $1,600,000 is one lump amount that's due in 20 years. So the present value of a single payment at the end of 40 periods at a 6% rate is valued right now at $155,200. So the difference, we got to add the two. We have to add the present value of all of our interest payments plus the present value of what we ultimately owe back in 20 years. We add them together. So that bond that we just issued, the present value of it is $2,081,088. Because we're not just paying the $1,600,000, we have to pay interest on it at 12%. Does that make sense? In the same respect here with choice B, if we go to table 1, instead of 40 periods, it's 30 periods. Well, then this $1,600,000, the present value of that is $278,400, because it's going to be due sooner than in choice A. So in this case, we're going to record on our books $4,011,288 as the present value of those bonds we're issuing. We kind of got ahead of ourselves by me doing that one. Let's go to, let's do E4A, okay? E4A says, use the present value tables in Appendix B to calculate the issue price of a $600,000 bond issue in each of the following independent cases. Assume interest is paid semi-annually. So we're issuing a $600,000 bond. It's 10 years. The bond issue on its face shows a 10% interest rate, but the market interest rate is 10%. So what the face shows is 8, but the market is actually 10. So since the market is greater than the face, we're going to have to issue those at a discount, aren't we? So if you go here, the present value of 20 payments at 5% interest rate every 6 months, or 10% a year. If we go to that table, then let me just go back here and make sure I'm telling you everything. A 10-year, 8% bond issue, the market interest rate is 10%. So 600,000 times 4% is what? How? Wait a minute, I'm screwed. 5%, 5%. Okay. The face shows it's an 8%, but the market rate is really 10. Okay? So 10% annually really means 5% semi-annually. So 600,000 times 5%, which we have present value of 20 payments at 5%. Where does it tell us 24,000? 600,000, 10%. What is 600,000 times? The face amount shows 600,000 at 4% semi-annually. So we know that they need to pay interest of 600,000 times 4%, or 24,000 every 6 months, okay? So as you see here, the 24,000 is the payment that is on the face amount. 600,000 times the 4% semi-annually. But what we're going to do is go to the table of an annuity, and we're going to look at 20 payments, because the market rate is semi-annually, or 2 times a year, times 10 years, at a 5% interest rate semi-annually, or 10% annually. So if we take our 24,000 times the figure we come up with of 12.462, the present value of all these payments is $299,088. Now, at the end of 10 years, we have to pay back the entire amount, face amount of 600,000. 600,000, and we're going to use table 1 because it's a lump sum payment, times, we go to the chart and show 20 periods at 5%, a single payment. The 600,000, we'll find the figure 0.377, which the present value of that is $226,200. If we add the two together, the present value of these two numbers added together is $525,288. What I want you to do is take what we did in A and try to see, I'm going to keep this up here, but I want to see if you can try to figure out B. Okay? Okay, 24,000 comes in because we are showing a $600,000 bond at an 8% interest rate annually, but we're paying it twice a year. So really, we're paying 600,000 times 4%. 600 times 4% is 24,000. Okay? That's the payment we know we've got to make, because we do it based on what the face value shows. So if that's what we need to pay, then we also need to go and look at the table to see what the market rate is. So $24,000, but the market rate is really 10% annually or 5% semi-annually. So that's how we calculate based on that figure we get from the table. This is using table 2 because we're paying it over 20 installments. The reason we use table 1 is that lump sum we owe at the end of 10 years or 20 payments is only going to be paid out one time. So what we're trying to do is figure out what's the present value of all this money we need to pay back. Okay? Where B is different is the interest rates are different. Okay? If you look at B, instead of the interest rate being, the market rate being 10%, the market rate's just 6%, isn't it? So you're going to look at, instead of the 5%, you're going to take the same number of periods, but you're going to change the interest rate. So as you can see here, since the interest rate is lower than in A, look at the present value. It's a lot higher than in A because we're paying less interest on it. And then C should be right in the middle of A and B, because instead of having a 10% interest rate or a 6%, now we have an 8% interest rate. Does that make sense? Kind of? The annuity. Correct. Exactly. That's where we get the 24,000.
So then the 14.7 in the back, what are you looking at?
You're going to look on table 2, 20 periods, because it's 10 years twice a year. So 20 periods. And what is the interest rate twice a year? You know, each semi-annually it's 3%. So if you go to the table and you see, you go 3% interest, 20 periods, you're going to come up with this number 14.878. Does that make sense? The second one, instead of paying twice a year or 20 periods, this is one lump sum we pay at the end of 10 years or 20 periods at 3%. Okay? So we'll use table 1 because instead of it being a series of payments, it's one payment at the end of the period. You guys are all falling asleep on me. I know. One payment. One payment at the end is 20 payments.